cannot be in audit currently. We're prohibited from trying to make a private letter ruling for an issue that is before in the audit process. So again, just some general guidelines, but again, we do work on these. We try to really get you good answers. One person may draft it, but it is circulated. We do have meetings about these, and we have some give and take. Different perspectives are presented, and we try to come to a cohesive response. But it does take a little bit of time. We usually say give us about 30 business days to respond to this. Sometimes it's a little bit quicker. Sometimes if new facts and circumstances come into play, it may take a little bit longer, but we try to get a response back to you within 30 business days. And again, this is your proof of due diligence. So if we do issue a private letter ruling and you rely on that ruling and you are audited for some reason and the auditors come up with saying we should have done things differently, you can show them that ruling, and that is going to be your basis of why you did it. We tried to do our due diligence. We're trying to apply the law the best we know how. So again, private letter ruling, that is a very good tool, and we would encourage you to maybe look at that, particularly if you have a complex issue that you want resolved or some guidance on. With that, we're going to kind of jump into the history of sales tax. Believe it or not, sales tax has been here in Kansas, at least at the state level, since 1937. So it's been around for about 85 years. If you look at the chart on the left of your screen, you'll see that it started out about 2%, and you'll see how it's progressed over the years, and now it's currently at 6.5%. This is currently the second largest source of revenue for the state of Kansas, particularly the state general fund. So about 1/3 of the state general fund comes from sales tax. Individual income is the only other source of revenue that is larger, and it's about 50%. But sales tax generates in excess of $2.5 billion a year for the state general fund. So it is a large source of revenue. Kind of talking a little bit of the history of this, Carl did some great research on these little tokens that you see in that graph. When the sales tax was enacted in 1937, they had these little tokens, and these tokens are a meal, which is 1,000th of something. For those of you who are familiar with property tax, a meal is 1,000th of your assessed valuation. So in this case, a meal is 1,000th of a dime or 1% of a penny. Well, these little tokens were used for small transactions. And back in 1937, you could probably actually buy something for a penny or two. So you had to buy these in addition, and so you'd pony up your penny and you'd have to give in a token or two. And so that's how it kind of operated. Well, these tokens were not very well liked, and while Kansas retained the sales tax, I think these tokens were gone in about 18 months or so. But that's how it was first used and how it was first applied. But as you can see, the sales tax has been around for a long time here in Kansas. When talking about the sales tax here in Kansas, we're really looking at a combined sales tax rate, which is comprised of the state rate of 6.5%. In 1978, counties and cities were allowed to join or allowed to impose a sales tax on their own. And so that's added on to the state's rate. And then we have things like community improvement districts and transportation districts that can levy a sales tax above the state and the city and county rate. A lot of times, like on these community improvement districts, we're building a strip mall or building a new business, and that increase in sales tax is used to help pay off the financing for these malls or new buildings or improvements that are being made. Because of this, Kansas has over 1,000 taxing jurisdictions. So there are a lot of different combinations of state, local sales tax out there. So again, 1,000 of them. So trying to determine which jurisdiction transaction belongs to can be challenging at times, we'll put it that way. But again, we're looking at a combined rate, and you'll see we have listed one of the highest sales tax rate is at 11.6%, and it involves a community improvement or district in Franklin County, I think in the city of Ottawa. So that's at 11.6. You'll see that there are a lot at 11.5. And again, these are usually hotels or some type of development. So again, there's various, like I said, that's the combined sales tax rate. So if you purchase something in one of those community improvement districts, you're going to be paying the 11.6 or 11.5. We get into the law itself, and sales tax is imposed under Kansas statutes annotated, we call it KSA 793603. And I love the way the wording of this is: for the privilege of engaging in the business of selling tangible personal property at retail in this state, or rendering or furnishing any of the services taxable under this act. So for the privilege of engaging in business, you become agents of the Kansas Department of Revenue and are actually charged with collecting and remitting the tax. And sales tax here in Kansas is kind of comprised of 4 different criteria. The most common is the retail sale of tangible personal property. You know, when we go to the grocery store, when we go to Walmart, when we go to Best Buy and take the stuff up to the counter, they ring it up. You have an itemized list. At the bottom, it shows the sales tax. And that's what we're most familiar with, and that's what most of us think about when we hear retail sales tax. Again, it is on tangible personal property, so it is something you can touch, feel, see. But it is also, and when you're at the legislature and you can write what things mean, they've also included in the definition of tangible personal property electricity, water, gas, steam, and pre-written computer software. So those are also, if you sell, rent, lease those in certain instances, those are subject to tax also. We also tax labor services. Now, not all labor services, we kind of break that down. Labor services that repair, service, alter, or maintain tangible personal property. So in that case, if we go and get our cars repaired, that is usually a taxable event. If somebody comes out and repairs an appliance, that can be a taxable event. If we take our pet to the vet and have them groomed or treated, that is a taxable event because pets are considered tangible personal property. Now, there are certain labor services that are not taxed, and that's generally accountants, lawyers, doctors and dentists. Again, they are maintaining, but they are maintaining humans, not tangible personal property. Same is true of hairdressers and barbers, that type of work. And then there are certain services like mowing, snow removal, or trash hauling. We're not installing or applying or repairing or servicing, so those are generally not taxed. So like I said, we have the repair, service, alter, and maintaining tangible personal property, but then we have the installation or applying tangible personal property into real property, and that's generally contractors. And Carl did a course this morning on contractors, which is much more involved and has a lot more nuances than just the normal retail sales tax. So again, we do labor services, and then we also charge sales tax on admissions. So if we go to a play, a concert, a sporting event, generally admissions into those, sales tax is going to be charged. And finally, sales tax is also charged on warranties if that warranty calls for performance of a taxable service. So, you know, again, if I have a warranty that takes care of my car repair, when I buy that warranty, I'm going to have to pay sales tax on it because it's dealing with maintaining my vehicle. Now, the interesting thing is if I actually have to have the vehicle repaired and it's covered under the warranty, if there's some type of deductible, I will also have to pay tax on that. So let's say I have take my car in, it needs $1,000 worth of work. There's $100 that I'm responsible for. At that point, I will have to pay the tax on $100, but the other $900 should be tax exempt. So that's kind of what we look at when we're talking retail sales tax, the different areas that are taxed. And that's going to lead us into, well, what dollar amount do we charge sales tax on? And here in Kansas, the statutes have defined gross receipts. So that means the total selling price, including any shipping, handling, freight, or delivery. And so you kind of see how that is broken out. We see that we're selling an item for $100. There's a shipping charge of $10, and that may change here. We'll talk about that in a couple of minutes. But we have a COVID-19 fee of $20. How many of you are seeing fuel surcharges right about now? We're seeing a little bit of that. So we take that total, we add all those elements together and come up with a total of $130. We apply a tax of 9.15%, which is a sales tax rate here in the city of Topeka. And we come up with a total amount that's due from the customer of $141.90. So that's kind of, like I said, we take everything, unless it specifically says we can exclude it. Gross receipts means the total selling price and everything that arrived, all the criteria that is used to arrive at that cost. So I did say that something may be changing here, and that is that if starting in July 1st, 2023, if our shipping or delivery charges are separately stated, that will no longer be subject to sales tax. There was some legislation this year. The legislation is actually a little bit confusing. We actually had House Bill 2239 pass, and it was going to say delivery charges would be, if separately stated, wouldn't be taxed effective July 1st of this year. Well, House Bill 2136 was passed late in the session, and it kind of moved that date back to July 1st, 2023. We did get a request in from a taxpayer questioning the implementation, and they really thought that the July 1st, 2022 date should take effect because House Bill 2136 should have been passed first, and House Bill 2239 should have been passed later. Unfortunately, that's not how the legislature does business. It actually passed 2239 first, 2136 at a later date, and it amended 2239. But again, big takeaway on this is July 1st, 2023. If you separately state your shipping delivery charges on the invoice, those charges will not be subject to sales tax. And I think have an example in there of how that might look. You see the sales tax coming to a subtotal of 120 with just the fuel and the items sold, $10.98. Sales tax on the 120 leaves a total of $130.98, and then the $10 shipping would be added on top of that. So the total amount due from the customer should be $140.98. And again, so how do we show the sales tax that was paid? How do we show that on our receipts? How do we show that on our invoices, our billing statements? Well, one is what most of us are used to. Like I said earlier, we go into Walmart, we go into Best Buy, we purchase the item, and then we see the sales tax listed and total amount due. That's what we're most familiar with. But there is also, the statute also allows for another method, and that is you don't have to show the sales tax separately stated, as long as you have on the invoice or receipt all applicable sales taxes included. So one or the other, we either list out the sales tax, or we have the statement that all applicable sales tax has been included. But it's very important to have either one of the two, because the statute basically says if it's not listed or the statement is not included, it is presumed that the sales tax was not collected by the retailer. And you really, as a retailer, don't want that to occur. You could maybe end up being liable for that tax. So you really want to have that listed out there, because like I said, the statute says the presumption is if you don't list it out or show it or contain the statement, that it was not collected. Okay, so now we talk a little bit, okay, so sales tax. What rate do we charge? And like I said, Kansas has over 1,000 taxing jurisdictions. So what sales tax rate do we charge? Well, in Kansas, we use a concept called destination sourcing. And it basically is you charge the sales tax in effect where the customer takes delivery of the item sold or where the service is first used. So an example of that, again, we go to Best Buy, I buy a laptop computer there, I'm taking delivery of it there, and at Best Buy, and if I'm doing that here in Topeka, they're going to charge me sales tax of 9.15% on my purchase. If I travel down to Wichita and buy something down there, even though I'm a resident of Topeka, but if I go down to Wichita and buy something there, maybe I go to Best Buy and buy the same computer. Well, I might get it a little bit cheaper because Wichita has one of the lower sales tax rates in the state, and it's something like 7 or 7.5%. So I can actually save a couple of percent, and that's perfectly legal, but that's where I'm taking delivery of it. Also, we look at if it's a service, where's the service first used? So, if someone is repairing my car, it's probably, and I take it into their shop. When I pick up that car, I'm first using the repair service there, and so it would be the sales tax rate at the shop. If for some reason someone would come out to my house and do some type of work on the car, probably they really need to be looking at what the sales tax rate is where I live. So that's what we're kind of looking at. Destination sourcing. It's where customer first takes delivery of the item sold or where the service is first used. Now, like I said, we've talked about this a couple of times now. There's over 1,000 taxing jurisdictions in Kansas. And sometimes it can be very, very difficult to determine what the actual sales tax rate should be. But there is a tool on the Kansas Department of Revenue's website. So if you go to our main page, and I apologize, that should be ksrevenue.gov, not org. We changed that here not too long ago, but it should be .gov. And if you're seeing the whole page, but normally when it comes on the screen, you're going to have to scroll down a little bit, but you'll see on the right hand that there's those 5 boxes that will take you to different links. And on the right hand of the screen, you see those boxes being blown up, and you'll see that one of them is a sales tax rate locator. So you would click on that, and you would say calculate tax by address. And like I said, this is really, really important, and to get the address and it's really important to use this and to enter the correct address, because different jurisdictions, you can be in a different jurisdiction by just being a business next door. For example, we hear stories about the Legends in Kansas City. Two retailers are right next door to one another, but one is in one jurisdiction and another is in another jurisdiction, so there are different tax rates. So that address becomes very important. And we also have those instances where one side of the street may be in one jurisdiction and the other side of the street is on another jurisdiction. So again, getting the street address, the zip code, that's all very important. So again, we say calculate tax by address, and you'll see there's.
Looks we have someone, looks like Tricia has a question that says, how does this work for online sales that are purchased from you by someone in another state?
Okay, so we have an online sale, and you're being okay. So would you read it to me again, Carl? I'm having.
Yeah, sure. It says, how does this work for online sales that are purchased from you by someone in another state? So if you're selling to someone in another state, customers in another state.
Okay. In that instance, it is really dependent upon how it's delivered. If you're delivering that or having it delivered to that person in another state, in that instance, Kansas does not have sales tax jurisdiction over that transaction. And we'll talk about that in a little bit. Because it's outside the borders. So if they're taking delivery of the items you sold outside of the state of Kansas, we don't really have jurisdiction over that issue. Now, the kicker may be that if you're selling into another state and it's Oklahoma, you may trigger a sales tax requirement in Oklahoma, and we may not. And that would be something for you maybe would have to research and contact their Department of Revenue about. But as far as Kansas goes, since delivery isn't occurring in Kansas, or they're not taking possession in Kansas, then we really don't have a jurisdiction on that issue.
She also asked, but if you ship it, is that something you need to remit tax on the shipping?
If you're just shipping, I don't believe there's a tax imposition on shipping it.
So if it's, the shipping is not a taxable service, but it's only taxable if it's attached to something taxable.
Right.
So if you're selling something outside of the state and the end user takes delivery of it outside of the state and you ship it there, it's going to be subject to the sales tax laws in the other state, but Kansas is out of the loop. There'd be no Kansas sales tax. And see, and she asked, is it because they are the end user? When you say they, I think you mean the person in the other state. The end user is the person who typically needs to pay the sales tax. So yeah, so wherever they take delivery of it, I'll let Roger, because Roger's going to be explaining this a little bit further here in just a minute. So I'll let him explain that, and please feel free to ask more questions.
Right. Basically, under the destination-based sourcing rules, reason we're not charging tax here in Kansas is because it's outside of our boundaries and we don't have jurisdiction on it. That is, they may very well be the end user, but it's not occurring. The delivery isn't occurring here in Kansas, and we can't tax outside our boundaries or borders generally. So that's hopefully, and like I said, hopefully we'll address this a little bit more in the presentation. But again, we were kind of looking at, okay, we're having a sale here in Kansas. We need to find what the jurisdiction is. and we're going to use this locator. So we pull that up. We're going to put in the street address. And if at all possible, we actually need the zip +4 because it can be that detailed on it. So with that being said, and if you're like me, I don't know, I know what my zip code is. I don't know what the zip +4 is. So, but you really need to have that information. So if you, and now, hold on a second. There we go. So we really need to know the zip +4. If you don't have that information, you can go and look it up at the United States Postal Service. You can actually, again, look by address, zip code by address. You're going to enter the address and it will come back and it will give you the zip code and the +4. And so you'll basically take that +4 information, you'll go back to our input screen and you'll enter the zip code and the +4, and it will kick you back what the code is. It will tell you what jurisdiction, the total tax rate. It will actually break it down. All that's very, very useful information. But the one thing you really want to do is print a copy of this off and get that request number. And you might want to attach it to your invoice just to show that you had some question about the correct sales tax jurisdiction and you exercised your due diligence. You went out there and looked for it. You got this information off the department's website. So that is, again, if you collected the incorrect amount of tax, you can come back and point it back and say, hey, I collected based on what the state was telling me. So again, this is printing these off and keeping a copy of this is really good. It kind of helps protect you to justify why you use the sales tax jurisdiction that you did. Alluding to Trisha's question, we're going to now talk about sales delivered outside of Kansas. And this is what we were alluded to before. No Kansas sales tax is due when an item is shipped or delivered to a point outside of Kansas. And like I said, we can only apply Kansas law to transactions that are occurring within Kansas. If it's outside our boundaries, we don't have the ability to enforce our laws in another state. Like I said, if you're a retailer and doing business over the internet in multiple states, you may want to become fairly well versed of what those other states' requirements are. Because like I said, in this case, we may be selling something, you may be selling something in Missouri, and while you will have no Kansas tax liability, you may definitely have a liability to Missouri. So you may want to keep that in mind, because that is probably one of the biggest areas right now in sales tax is retailers doing internet sales in multiple states. And that is going to lead us into talking about when is an out-of-state retailer required to file and remit. And the first case we're going to look at is Quill Corporation versus North Dakota, and it was decided back in 1992. Most of you know Quill Corporation is a office supply catalog company. They do a lot of catalog sales and stuff. Well, back in 92, apparently North Dakota tried to tax part of their transactions. Court case ensued. It worked its way up to the United States Supreme Court, and the Supreme Court basically said that for a out-of-state retailer, for a state to be able to charge or require out-of-state retailer to register, remit, and collect sales tax, there had to be some type of physical presence in the state. So in this instance, if we're going to go North Dakota, you have to show where that out-of-state retailer has some type of connection with North Dakota. Maybe they have employees in the state, maybe in this case, maybe Quill Corporation delivers using their vehicles into the state of North Dakota. Maybe Quill Corporation owns some real estate in North Dakota, but there has to be some type of physical presence of that retailer in the state for the state to have the ability to require them to collect and remit sales tax. This is 1992. This is fairly early. Internet sales and that haven't taken off a whole lot. Jump forward about another 25 years, and we come up with the Wayfair decision. And this is actually the state of South Dakota versus Wayfair. And again, we're looking at this question. Again, when can a state require an out-of-state retailer to charge, collect, and remit sales tax? And what was an issue here was a South Dakota statute that basically said, hey, if you're an out-of-state retailer and do $100,000 worth of sales in the state of South Dakota or 200 transactions annually, we're going to say you have a connection with the state and you should be required to register, remit, and collect sales tax. Again, this worked its way through the courts. It went up to the U.S. Supreme Court, and the Supreme Court agreed with the state of South Dakota, saying, yeah, we're not only going to start looking for physical nexus, but we're going to look at economic nexus. So is there an economic impact on the state? And so with the Wayfair decision, you see a lot of states beginning to look at economic nexus. And all that is usually they have some type of threshold. A state has established some type of threshold, either in dollar amount of sales or transactions or both. And that requires that retailer to collect and remit tax to the various states they're doing business in. Kansas actually in 2021 passed legislation. It was Senate Bill 50, and we basically set that nexus or threshold at $100,000. And there's a couple of criteria: out-of-state retailer or a marketplace facilitator. One of them is $100,000 in gross sales. The other one is $100,000 in taxable sales. But again, if you reach that threshold, then at that point forward, you're responsible for collecting tax for transactions occurring here in Kansas. So like I said, you've seen the growth of the internet and internet sales, and now you've seen the court respond with the economic nexus theory. So with that, and you see states beginning to work together a little bit. There's this Streamlined sales tax organization, and they're kind of charged with developing common rules and definitions, but their whole intent or their whole purpose is trying to, and it's a compact of states, but they are trying to minimize the cost and administrative burdens of retailers, particularly those retailers that are operating in multiple states. So again, states are working together and trying to come up with some common definitions. So, each state kind of follows the same definition, so you don't have, all these different rules. And if you look at the table that we have up there, you will see that because of the Wayfair decision, a lot of states put in or use that $100,000 threshold. Now, some of them move up a little higher. You'll see Alabama, and Alabama is at 250,000. You'll see California is at $500,000. Again, the 100,000 was a threshold set by South Dakota, but other states have adopted that, but some of them adopt thresholds a little bit higher. A lot of them look at the $100,000 though as the threshold. Now, And here you see a map of the United States, and those states that are in blue, those have adopted the state streamlined agreement. They have adopted that. So there's 23 of those states that are kind of working together, trying to have some common definitions, that type of thing. We do have one associate state, which is Tennessee, which they have adopted most of the streamlined provisions, but not quite all of them. And so overall, we have 24 states participating in the streamlined state agreement. So again, and this is probably the biggest issue in sales tax right now, is going into states. I mean, it was so much easier when you were a brick building and doing business in one state, but if you have a presence on the internet and doing sales in multiple states and you may not have a physical presence, I mean, that is probably the biggest issue in retail sales tax right now. And to that end, if you are a retailer and you're doing business in multiple states, you may want to look up and see if you may want to look into contracting with the certified providers. They will help you meet your sales tax requirements, particularly if you're dealing with multiple states. So they might help you prepare and file the returns, make sure you're doing that correctly. Hopefully will provide you with a little bit of guidance and stuff. But yes, if you're like I said, if you're based here in Kansas and doing a lot of internet sales and that in other states and have a bunch of reporting requirements to it in a lot of different states, you may want to definitely look at this and see if this may benefit you. Okay, so the cardinal rule of sales tax, and that is charge sales tax or have a very good reason of why you don't charge the sales tax. And that's usually in the form of some type of exemption certificate, or you're shipping to customers outside of Kansas, and that's where they're taking delivery. So general rule is collect sales tax unless you have a good reason not to. And usually if you're looking here in Kansas, you know, most of the time you're going to take some type of sales tax exemption certificate from the purchaser. So, but again, there are different types of exemptions out there. And one of the first ones we're going to talk about is an exempt entity. And when we think of that, we normally think of governmental units, federal government, state government, local government, and local governments. It can be counties, cities, townships, cemetery districts, school districts, all of those type of entities. Most churches are going to be an exempt entity. And that kind of leads to a problem, because I think a lot of people think that since governments are exempt and churches are exempt, that all nonprofits are exempt, and that is not the case, at least not here in Kansas. Before I came here, I was a finance officer for a nonprofit, and we paid sales tax on all of our purchases. So it's not an automatic type of thing. Yes, there are some entities, some nonprofits that are tax exempt, are exempt entities, but they usually go through the process of going to the legislature and getting special provisions in statute that allows them to be an exempt entity. So like I said, the takeaway here is, yeah, if you're dealing with a local government or state government or federal government or church organization, those will probably be exempt entities, but nonprofits generally pay tax. Like I said, there are a few exceptions, and I believe in you. I think we have attached to your invite and your documents today a publication. It's KS-1510. I believe in that publication, you will see a list of entities that are exempt.
Looks like we got another question. Looks like Tricia has asked, are we supposed to charge sales tax at events for cash and card or just card-related purchases?
I don't think the method of payment is the determination here. If sales tax is imposed, you would collect tax whether it is cash sale or a charge sale. So is that addressing your question?
She said she asked because a friend in another state only has to do card charges.
Yeah, I don't believe the mechanism of payment makes any difference, at least not under Kansas law.
No.
So.
No, in fact, barter and trade's taxable.
See, Carl knows all the answers to this. But yeah, so like I said, if you look at our publication KS-1510, page 6 will give you a list of nonprofits and that have went through that special legislative process or have legislation that make them an exempt entity. But again, takeaway from this is not all nonprofits are tax exempt or exempt entities. Most of them will be paying taxes on their purchases. So we have the exemptions for exempt entities. And then we have exemptions for specific items. So if you're in a manufacturing business, you know, your production machinery and equipment, there's exemptions for that in statute. They have a sister provision for warehouse and distribution centers, the machinery and equipment you use for that. You know, if you're involved in the aircraft industries, aircraft sales, parts, repairs, services for carriers in interstate or foreign commerce, those are exempt. So you have specific items that are exempt in Kansas statutes. And that's an example of a few of those. And then sometimes how the item is used will qualify for exemption. Again, Carl has this great example. You know, you sell cheeseburgers. Well, your ingredient or component parts would be exempt from tax. So your hamburger, your bun, your cheese, your bacon, vegetables, if you know, your tomatoes, your onions, your lettuce, those would be an ingredient or component part. The containers, the paper sacks that you carry out in, all those kind of things would be exempt. Obviously, if you're a retailer and you're purchasing inventory, that's going to be exempt from tax because you're going to turn around and collect sales tax from the end user when they purchase it from you. And sometimes how the items are being used, again, there are a lot of items like agriculture. Just because something is purchased for agriculture doesn't automatically make it exempt. But, you know, if it's farm machinery or equipment that's used in agriculture, those type of items can be exempt. But again, not everything related to farm or farming is exempt from sales tax. But again, that just kind of gives you a flavor of how exemptions work a little bit. And again, here, this is the page I was alluding to a little bit earlier, that it kind of goes through and shows the different nonprofits that have applied for exemption through the legislative process. And So it kind of gives you an idea who may be out there. But like I said, nonprofits generally do pay sales tax on their purchases. Okay, so now we're going to take a look at the different type of exemptions and certificates you may see. Again, this will normally be provided to the seller by the buyer. And for those exempt entities, those churches, those local governments, this is what you will normally see if you're a retailer and they're purchasing something from you. And we just caution you, though, that these have to be a direct purchase. The church or the government have to be purchasing these services directly from you. So a great example of this, have a pastor that's buying some office supplies for the church. Pastor goes into the office supply store, buys the supplies, goes to pay, tells the clerk it should be tax exempt, hands them a credit card. Clerk looks at it. Clerk is really on the ball in this case. Clerk looks at it and says that, Pastor, we can't do this. It's just in your name, and we can't because the church isn't purchasing it directly. It's your credit card. Pastor says, you're absolutely correct. I have another card in here they gave me just for this purpose. Gives that to the clerk. It has the church's name on it along with the pastor's name. That is considered a direct purchase. And the transaction can process being tax exempt. And credit card isn't the only way. If he would bring in a check written on the church account, they could do it that way. What he can't do, though, he can't reach into his wallet and pay cash, and he may make the argument, I'm going to be reimbursed, but it's still not a direct purchase. It needs to come some form or fashion, have the church's name associated with it, and then cash will not cover that. Now, if you get one of these and you have a customer that's reoccurring, you don't necessarily need entity exemption certificate for every transaction. There is a blanket provision in there. So if you have more than one sale every 12 months, more than one sale every 12 months for this entity, you can just keep a copy of it, and you don't need to get a copy of this for every transaction that comes through. And I believe these exemption certificates are renewed or reissued every 4 years. So if you see some that looks like we're probably going to start issuing or they're going to expire in October of 2024. So after that date, you may want to grab a new one. But again, you should probably be grabbing these, at least a copy of one, or asking for one at least once a year, just to have it on file. So again, that's usually those entities that are exempt from tax, and they'll have that certificate and they will give that to you. This is probably one of the more common exemption certificates you will see. It is an ST28A. But this is really when you're purchasing inventory for resale. This is when you will actually be seeing this for the most part. And again, when you make those sales, you want to keep this, attach it to the invoice, because that is your rationale for not charging sales tax. And basically, the buyer is saying, hey, I'm going to turn around and resell this. And so I'm going to sell it to the end user. So that's why I'm asking you to sell it to me without tax. And again, please, these are to go to the vendor. Do not send them to us, because we don't want to see these. The only folks that want to see these are our auditors when they're out there auditing. So please don't send them to the Department of Revenue, because we're not really the ones that need to be keeping these. So again, you want to give them to your vendors. The next most common one you probably will have is the ingredient or component part. Again, going back to our cheeseburger example, this is what you would give your supplier. So who you're buying your food from, your utensils, your carryout, that type of thing. You're going to present them this exemption, and that's going to be, they won't charge you tax on those items that you purchase that are ingredient or component parts for your business. So again, that's probably one of the more common exemption certificates you will see. And then we do have a multi-jurisdiction exemption certificate, and I think this is kind of a catch-all, for lack of a better term, but you normally will use this if either the buyer or seller is outside of Kansas. And the only time you might use this for a Kansas business is if that business is a wholesaler here in Kansas and they don't have a registration number, because we basically ask for a registration number on these documents. So again, you would use this multi-jurisdiction exemption certificate if either the buyer or seller is outside of Kansas, or you have a business who is a wholesaler in Kansas and they don't have a registration number. And then this is the Streamlined Sales and Use Tax Agreement Certificate of Exemption. Again, this is a generic one. You may have to look at the specifics a little bit more. But yeah, this is meant to be a general exemption certificate. So you may have to go through and make sure you meet the criteria and the exemption can actually be taken, but that is available out there. Okay, if you're a business, you do owe sales tax on the tools of your trade. So let's say I start an accounting firm. I am going to have to pay sales tax on calculators, computers, desk, software that I may purchase if it's pre-written and it comes to me in a form that I can load onto my computers and that type of thing. So anything that's a tool of my trade, I'm going to pay tax on. Same is true of most other occupations. If I'm a mechanic, the tools I use, the equipment I use, that's going to be subject to tax. So again, you just keep that those items are generally taxable. Record keeping, again, this is probably one of the most important aspects of this job. You're going to want to keep your receipts, obviously your gross receipts, your sales records, that type of thing. And you're going to keep them regardless or not if the receipts are considered to be taxable or non-taxable, because when our auditors come in, they're going to look at everything, or they're going to pull a random sample of your receipts. If you're claiming certain deductions, you want to keep that information associated with that. Purchase price of your tangible personal property, obviously the cost of your inventory, you're going to keep cost of goods sold, so your inventory cost will be recorded. Your equipment and fixtures should be recorded as fixed assets. Your exemption certificates, you're going to want to keep copies of those. And we've had a long discussion on this last item. I think an inventory has to be taken. We kind of question when it needs to be done, but just normal record keeping requirements. We're not asking anything outside the norm. If you're a large enough business and you have a financial audit being performed, financial auditors are going to ask for all of these same things. So again, nothing special. This is just part of doing business and part of the record keeping requirements of doing business. Once you registered for a sales tax number, and once it's been processed, you're going to get this registration certificate. Please, please keep this. This is your documentation that you are registered and can do business in Kansas. You normally should keep this and display this. Now, your vendors may want copies of this, and you certainly can make a copy of it and give it to the vendor, but you really want to keep the original. Again, and it should, normally we say it should be displayed where folks can see that you're licensed and registered. So again, if your vendors want copies of it, they certainly can have copies, but do not give them the originals. Our least favorite subject, again, is the audits. Again, you want to keep your records for at least 3 years. And with our auditors, they're a little bit different than the financial auditors are. The financial auditors are going to look at your financial statements as a whole, but our auditors are going to look and say, you know, did you collect and remit sales tax if you were supposed to, or where there's an exemption or a reason that you did not collect the tax. So that's the primary emphasis of our auditors. And again, the audit, just like a financial audit, is going to be a random sample. If they look at a 3-year time span, they will pull receipt, invoices, that type of thing, pull a random sample for the 3-year period. They're going to come up with some projections, and if they say an additional tax was owed based on the sample side, they're going to project that out for the entire 3-year period. So again, this is very much like a financial audit from the standpoint of, you know, trying to make a determination if you're in compliance or not. Again, and financial audits as well as our audits are based on representative samples taking. So that again is pretty standard business practice there. Only difference is it's auditors from the Department of Revenue rather than your financial auditors. Hopefully we will have you, if you are doing retail sales or need to remit and collect tax, you apply for a sales tax registration number. Basically do that online. If you need some help in that process, you can contact our Taxpayer Assistance Center at 785-368-8222. That number is also on the back of many of our publications and stuff, but they are very good at helping and walking you through stuff. Don't call me because I will just lead you astray. But they deal with this every day, so they are pretty good at walking you through the process. But if you have a sales tax registration number, it's going to start with 004. You'll see that the next few characters, the next 9 characters, are probably your FEIN number. Then there's going to be an A or an F, and then a dash 01. 02, and that 01, 02, 03, that last number just designates how many locations you have in Kansas. Again, to go through this process to get a number, you're going to register a KS web file. And again, it will just you'll have to establish an account, but it will walk you through the process. And again, if you need some help in that process or have questions, we'd really encourage you to contact the Taxpayer Assistance Center. So once you're registered and you're starting to collect tax and that, how often does the return need to be filed? Well, it's actually going to be based on what your tax liability is projected to be. Not what your sales are projected to be, but what your tax liability is projected to be. So an annual filer, you're going to have a projected sales tax liability between $0 and $400. And this is probably the worst one to remember because you only do this annually. If you're on a calendar year, your return is going to be due January the 25th of the following year. So if you're an annual filer and we're through calendar year 2022, the return will be due January 25th of 2023. Now, if you've worked in a finance office someplace, you know this is going to probably be pretty easy to slip through the cracks, because if you work in a finance office, you don't have anything else going on in January, do you? I mean, you've got W-2s you're trying to get out of the door, 1099s, you've got quarterly reporting you have to be doing for both the feds, unemployment, that type of thing. So you've got a lot going on at the end of the year. And I will share that when I was finance officer at the nonprofit, I got a reminder more than once that we had not filed this because I just got lost in the shuffle. But put it on your calendar, a little bit of a reminder that, hey, we have to file this by January the 25th. So if you have an annual, you're an annual filer. Again, if your annual tax liability is between 0 and 400. If you're between $400.01 and $4,000, you're a quarterly filer, and it's again going to be the 25th day of the month following the end of the quarter. So again, April 25th, July 25th, October 25th, and January 25th. And finally, if your annual tax liability is estimated to be $4,000.01 or more, you're going to be a monthly filer, and it's going to be due the 25th day following the end of the month. So for January, for the month of January, the return is due by February the 25th. There used to be an accelerated monthly, and with legislation that became effective July 1st of this year, that is no longer applicable. So consider yourself lucky you got out of that one. That tended to be a little bit of a pain, and I don't think anybody is sorry to see that go. So when you're actually trying to report your sales tax, we'll probably want to do that, or want you to do that electronically. You will set up an account. When you go in there to see that your account, you will see the different tax accounts that you have. In this particular instance, we have a sales tax account and we have a withholding account. They all kind of come up together. But you'll want to look for sales tax purposes. Obviously, you'll want to select the sales tax account number. It will bring up some information that you'll want to confirm before you start entering information. You want to make sure your tax account number is correct, your EIN, your business name, your filing frequency is all good. And then Tricia has a question here. The seller doesn't collect sales tax but remits the amount anyway. Is there a legal punishment for that, or is it just nonsense because it hurts profits? I believe that there is a legal ramification for this, because you're really, as the seller, you're required to collect from the consumer. I think there's legislation. Carl, can you jump in there? But
so long as the amount of tax is paid, so what you're saying is someone didn't pay you tax, but you go ahead and pay it, that means you're going to make less, because you're responsible for the sales tax if you're selling. But I mean, you won't be in business if you do that. So there is a law also, if you collect the wrong amount, you must either refund it back to the customer or remit it to Kansas. You can't keep the difference. But in your scenario, you're saying basically, well, my customer didn't pay, but I'm going to pay what I should have. Well, that means you'd have to collect tax on what you sold it to them for. So yeah, that would definitely hurt your bottom line. They wouldn't go after you, because if you did that, then you paid the amount of sales tax owed. But that's really not how it's supposed to work. But I mean, you won't be in business very long doing that.
Okay. And I think I'm confusing this, Carl. There is a provision that says that the seller won't. Isn't there a provision in law that says seller won't cannot
Seller must, yeah, there actually
cannot
is. You're
say
right.
they'll pay the.
So if they're caught, if you collected and paid, you're required to collect and they're required to pay. So there actually is a provision in the law that says you must do that. But if the tax was paid, typically they're not going to really go after anyone. I mean, because they've already got their money. But yeah, there actually is a law that says you must collect as a seller and they must pay. So it doesn't just stop that you must collect. It says that they must also pay.
So see, Carl is much nicer than I am. He is. But no, but that's a good question.
No, I'm not.
So again, so when you pull up and you're starting to work your return, you want to make sure the information's correct, your filing frequency, the period you're reporting for, the return type, all that is correct. Of course, we're going to want to make sure you confirm your banking information, because you're going to tell us when we can go out there and pull that information from your bank account. So we want to make sure that's all, the routing information and the account number. The account type is all correct. And a lot of times people overlook that account type. I know in my previous life, if we did not get that correct, it would be rejected. So every once in a while, somebody would have us do something from a savings account rather than checking. And if we weren't close and watching that, the bank, it would come back from the bank and they wouldn't honor it. So you may want to pay a little bit of attention to that. Then you're actually going to start working on filing the return. And again, you want to make sure your filing period is correct. If it's an original return or an amended return. And then there's a radio button for additional return. And this may be a case where, again, where you're an annual filer, and let's say, maybe you have an event in February and March and you collect some sales tax and maybe it's $100. Well, if you're an annual filer, you won't report that till January 25th of the following year. And you go, well, I don't want to carry that on the books or keep on remembering that. So you can click that additional return and file and remit that $100 or whatever. And then when January 25th rolls around, do the original return, and hopefully all that good stuff marries up. But like I said, that's maybe when you're going to use that additional return, when you've collected monies and you don't want to track it, or you want to go ahead and pass it on to the department, and so you're not having to worry about that. And again, just make sure everything looks good and you're pushing, everything looks good. Then you're starting to look at, you're actually getting into the meat of filing the return. So you look at what jurisdictions you're actually going to report for. So you can go through, if you're a large retailer with multiple jurisdictions, you're probably going to have a staff that does this. But even if you're a smaller one and you're doing a lot of sales where you're shipping in that, this could be a little bit of fun to go through and check off the different jurisdictions. But if you're based in one or two, do your sales primarily in 2 or 3 different locations, you may be able to click that up and click them, and then next time you file, you'll say, yeah, just bring up the ones I've already got. But again, if you're adding a bunch of new ones, you may have to pull this up and go through all of these and click the jurisdictions that you need. Once you're done with that, then you're actually going to start filling in the information for the return. And actually it's kind of backwards. For the return electronically anyway, you're going to start with part 3. So you're going to look at your different jurisdictions and break down your sales by the different jurisdictions. So you see in our example, we have Junction City, we have Topeka, Shawnee, Wichita, Sedgwick. Well, you're going to report your gross sales for each one of those jurisdictions. And you're going to want to do that net of tax. So I believe if your sales are showing with tax, I think you're going to have to back out of that. So you're going to want to back at the tax out and just show the gross sales by location. And then if there's any merchandise that's consumed by you, so let's say I have a clothing store and there's a pair of shoes that I really like. Well, I purchased that without tax as part of my inventory. Well, I'm really not selling it, but I'm pulling that inventory out of stock because I'm going to use it myself. Well, then that's where you would record the value of those shoes or what you paid for those shoes under merchandise consumed by you. Okay. And then if you have any deductions, again, certain exemptions, that's where you're going to list those exemptions. So if I sold farm machinery and equipment and I have an ag exemption for that, that's where I would back it out. I would come up with net sales, the sales tax rate for the jurisdiction, and then the net tax. So I would go through and do that for all my sales, all for my various different taxing jurisdictions. So once I'm done with part 3, I'm going to move to part 2. And again, I'm going to kind of spell out what my deductions are, but in this case, they're going to be an aggregate. We've broken down the deductions by different jurisdictions. Well, now we're going to kind of lump them together in aggregate. So my sales to other retailers for resale, I'm going to record that. If I made sales to the U.S. government, state of Kansas, or a political subdivision, I'm going to record those sales in there. So, and just kind of go through the list. The sale of farm equipment and machinery, I would list that there. Deliveries outside of Kansas, I would list that under M. And then if you have a deduction that we don't have listed out here, you would put that into N, all other allowable deductions. That's kind of the catch-all. Now, the important thing here is the total of your Part 2 deductions should match the total of your Part 3 deductions. So you would want to make sure those two are in agreement. And then once those two are in agreement and you think everything's ready, then you can go back to part 1. And the nice thing is part 1, it will calculate the tax for you. I don't think you have to worry about 4 and 5 anymore with the accelerated tax payments going away. If you have a credit memo, you might enter that into 7. Penalty and interest, if you think it's owing, rather than trying to guesstimate it myself, I'd probably just submit it and let the department assess it. But hopefully you don't have that issue, and then you come up with just the total amount due. And so if everything ties out, you're ready to look at what your payment options are going to be. In this case, here's basically authorizing the Department of Revenue to go into your bank account and pull the monies on a specific date. So you'll want to look at your due date, when you want them to pull it. Again, you might want to look at that comment up there that, sometimes you may have to give them a little bit of lead time. So like I said, if you've completed this on July the 25th and say, yeah, go ahead and pull it today, no, the way the banking system works, we need at least a day or two lead time. So you can't say it's due today and go ahead and pull it today. It's not going to work that way. There needs to be a little bit of time lag there, usually at least 1 day, sometimes maybe 2 days. So if you have a due date of 7/25, you may want to see if that can be done around 7/23 and again, but click the due date is 7/25, but you may need to have it actually completed a couple of days beforehand. Again, you want to check, make sure your bank routing number and account type and account numbers are all correct. You will hit review the information that comes up, make sure everything looks good. If everything looks good, you'll say hit submit return. When you submit the return, it will come back with a confirmation number. And I know when I was working for the nonprofit, we would print this off and actually attach it to the sales tax return. The same thing is true of withholding. Once we filed the withholding, we would do that and we would attach the confirmation number. Again, that's just some proof that you actually filed it and when it was done. Again, and I would, like I said, we would attach it to our returns just to let that, just for an additional piece of documentation that it was filed and filed timely. If you go to this screen here, you can look at your previously filed returns, click view, and it will show you your returns that have been filed by type. Again, so if you need some history or say, well, what did we do in July? You can certainly do that. While this is a nice tool and a nice feature and it is available to you, again, I would strongly encourage you that this should not be your only source of records of this. You should be keeping either your own electronic or paper copies in office. Again, like I said, this is a tool and it's nice to review and be able to see. But again, it's not a substitute for your own records. And then if your businesses really take off and become successful, you know, right now you may be starting off with just needing a retailer sales tax number. If you expand, you add employees, you may need to look at a withholding number. If you're a sole proprietor now, you may at some point maybe look at incorporating. You may want a corporate income tax number. Again, once you're registered and have an account, then you can add other accounts with an ID number and PIN. And again, if you're trying to add a withholding account number or a corporate income, you can call the customer service folks again, that 785-368-8222 number, and they'll be more than happy to walk you through the process. Okay, so now we're going to shift gears a little bit. We've been talking about retailer sales tax. And so now we're going to kind of shift gears and talk about compensating use tax. And compensating use tax has been around as long as retailer sales tax has been around. So it's about 85 years old. Also, you don't see this or not as familiar with this as much, but actually compensating use tax is when you buy something outside of Kansas, and hold on a second. Yeah, this slide is just kind of reviewing retailer sales tax at this point. I'm sorry. We're basically saying, hey, if you're shipping something outside the state of Kansas, we don't have jurisdiction over that. So you're not going to charge or collect Kansas sales tax for sales that occur outside our boundaries. Compensating use tax kind of works the opposite way. I go into Missouri and buy, let's say I go to Best Buy and buy a computer. in Missouri. I bring it back to Topeka, I store it, I use it, I consume it here in Topeka, Kansas. Let's say that in Missouri, I only paid 8% tax on that laptop. Said earlier that when I'm here in Topeka, the tax rate here is 9.15%. I actually owe 1.5% in compensating use tax on that purchase in Missouri that I brought back into Kansas because I'm using it, storing it, consuming it here in Kansas. I know we don't think about that a whole lot, but normally there is a tax, particularly if we went into another state and the sales tax, there is no sales tax being assessed in the other state, or the sales tax is at a lower rate than what the rate where I'm going to be using this. So if there's no sales tax or it's a lower rate, I'm probably liable for the difference on that. Now, if the sales tax rate in Missouri is higher, let's say it was 10% when I bring it back in, and it's 9.15%, I don't owe anything because the rate in the other state was higher, but I don't get a refund either on the difference. So, but again, that's something, like I said, a lot of people don't think a lot about. This is applicable to businesses too. If you buy the tools of your trade in another state and bring it back in, and if the sales tax rate is lower or non-existent, then we probably owe compensating use tax. The exemptions for compensating use tax follows retailer sales tax. So if it's exempt for sales, it's exempt for compensating use. So that's a good point to keep in mind. And again, the tax rate that we're looking at is where the item purchased will be used, stored, or consumed. So wherever I'm using that here in Kansas, that is the sales tax rate we're going to be looking at or making the comparison to. Again, if you have a question about what that sales tax rate is, that you can use that sales tax rate locator that we discussed earlier in the presentation. It's going to work just exactly the same way. So the zip +4, what your address is, and it should come up with what rate or what jurisdiction you fall into. And again, the tax is due on the purchase price, including shipping, handling, freight, any other charges. So again, if I purchased that in Missouri and it's a $100 item and there was a $10 shipping charge, it's $110 subtotal. And my compensating use is going to be 9.15%. The subtotal or the $110. So I'm actually going to owe $120.07 on this. But of that, $10.07 is the compensating use tax. But but that is me purchasing something in another state, bringing it back to use it Kansas, and I have paid a lesser tax. So again, we used to have a line item on the individual income tax return for a number of years where you could report compensating use tax, but that is gone now, and actually a return has to be filed now to report it. Again, if we're looking at audits, again, the same audit period, 3 years, and I believe Carl has said in the past that if you're audited for retail sales, you're going to be audited for compensating use also. They'll look at it at the same time. Again, so you want to retain your records for 3 years. Keep your receipts, show sales tax that you paid in the other state. Again, auditor will use a representative sample or a random sample, and they will try to project the results over a 3-year period. So pretty standard, just like the retail sales tax audit. And again, this tax is applicable to the office supplies, furnitures, tools of your trade. Again, if you're buying in another state, paying no or a lesser tax rate and bringing it back into Kansas, there's going to be tax on that difference. If you're a retailer and doing that, you may need to register for a retailer's compensating use tax number. If you're a consumer, you may also register for a number. Consumer's number is going to start with a 006. Retailer's a 005. Again, you can obtain the number online by registering. And again, that's going to be Kansas ksrevenue.gov. Again, how often is return filed? This should look very, very familiar. Again, it's based on your annual tax liability. So again, $0 to $400, it's going to be an annual filing. $400.01 to $4,000, it's going to be quarterly filing, and then anything over $4,000.01, it's going to be a monthly filing. And again, the accelerated monthly is gone for compensating use also. Form you would file is the CT10U. You can pull that off our website, I believe. And like I said, it used to be on the individual income tax return. Now, like I said, it's a return all by itself that you have to file separately. Okay. And again, just an overview, retailer sales tax, it's really collected by the seller, and it is based on where in Kansas the sale is made, where the buyer is taking possession of the goods or services, or first using the services. Whereas compensating use tax, it's a sale outside the state that's tangible personal property being brought back into the state to be stored, used, consumed, but the buyer pays the tax at where it's being used or consumed if that tax is greater than the tax paid in the other state. So clear as Mississippi mud, right? Guys, have any questions about that? We covered a lot of material fairly quickly, but again, I want to stress that we really view our job as education, and we really try to provide good answers and research. And so, like I said, you've got our contact information again. Those are direct telephone lines and direct email addresses. So if you do have questions, please do not hesitate to give us a call, send us an email. Like Carl said, sometimes we're out doing training, so it may be a day or two before we can get back to you. But again, give us a little bit of time, and we will try to answer your questions to the best of our ability. Do I have any other questions today?
I'm not seeing any.
Tricia says she'll be calling later. Have some very specific. Okay. So we will be looking forward to hearing from Tricia.
All right.
Anything else? Well, if not, I want to thank you all for attending today. Thank you for hanging in there for an hour and a half of tax. The only thing more fun of this than this is I do take federal income tax refresher once a year that is 16 hours long. So, you know, if you find this enjoyable, I need somebody to go along with me to the federal income tax
That,
class.
that's,
So
that's a
feel
cure for
free.
insomnia.
So if there's nothing else, once again, thank you. If you do have questions, please feel free to reach out to us and we'll try our best to answer. With that, have a good day, everyone.